Most beginners lose money because they do one of two things. They buy just because the indicator says oversold, or they sell just because it says overbought, without checking the actual trend. This strategy fixes that. I'm going to show you a very simple combination of two built-in TradingView indicators that tells you the trend, shows you clean pullbacks, and gives you clear, rule-based buy and sell signals. It's beginner-friendly, it works on any liquid market, and there's no guessing. So I'm on TradingView. You can use any pair or coin and any time frame, but for beginners, I recommend starting with the 15-minute or 1-hour chart so the moves are not too fast. Open the Indicators tab. Let's add the indicators and search for Stochastic. Add the built-in Stochastic oscillator, then search Stochastic RSI and add the built-in Stochastic RSI as well. These two will work together. Stochastic RSI will give us the main trend direction, and the normal stochastic will give us the actual entry timing during pullbacks. Now, let's set them up properly. First, open the settings of the stochastic oscillator. On the Inputs tab, set %K length to 7, %K smoothing to 3, and %D smoothing to 3. This makes the stochastic sensitive enough to catch pullbacks, but not so fast that it flips every candle. On the Style tab, just make both lines a little thicker, so they're easy to see. After these changes are done, click OK. Next, open the Stochastic RSI settings. On the Inputs tab, leave %K, %D, and RSI length at 3, 3, and 14. For the stochastic length, set it to 134. This longer length smooths the stock RSI and turns it into a slow trend filter instead of a fast, noisy oscillator. Then go to the Style tab, turn off the %K line, keep only the %D line, change it to white, and make it thicker. Make sure to carefully change the settings as I have done, so that you can easily follow the strategy I will show later in the video. Click OK. Now we'll combine them into one window, so reading them is easy. An easy way to do that is, on Stochastic RSI, click the three dots. Go to Move To and choose Existing Pane above. This one, so it drops into the stochastic window. Then again, on Stochastic RSI, click the three dots, go to Pin to Scale, and choose the same scale as the stochastic. You can follow the steps I have shown right now. And after that, you should see one white line and two faster lines, the blue and orange stochastic line in the same panel. Let me explain what each one does in simple words.
Do you feel like everyone around you benefits from artificial intelligence, but you have no idea where to start? Don't wait any longer. Start today. Our free trading bot is simple to use, powered by artificial intelligence, and can earn you up to 1% profit every single day. Over 500 members have already joined. Click the link below now to get free access. This is your chance to harness the power of AI and take a step toward a financial boost.
The white line is your trend meter. When the white line is above the middle 50 level, we say the market is in an uptrend, and we only want to look for buy trades. When the white line is below 50, the market is in a downtrend, and we only look for sell trades. That's it. No trend, no trade. The blue and orange lines are your entry engine. They move faster and show short-term overbought and oversold moves inside the trend. We use them to enter on pullbacks instead of randomly chasing candles. The benefit of this setup is simple. You're never buying in a confirmed downtrend and you're never selling in a confirmed uptrend. You only enter when the trend is clear and price has pulled back to an extreme level, then turns back in the direction of that main trend. This is exactly what beginners need. One line for trend, two lines for timing, and clear rules. Here's how we use the indicators for a buy setup. First, the white line must be above 50. That means we're in an uptrend and we are only allowed to look for buys. Second, we wait for the blue stochastic line to drop below the 20 level. This means price is oversold inside an uptrend, a healthy pullback, not a full reversal. Third, we wait for the blue line to cross back above the orange line while it is still close to that oversold area. That cross back up is our signal that the pullback is ending and buyers are stepping in again. When that cross happens and the white line is still above 50, the long signal is valid. And after that, we can open a buy position at the opening of the next candle. The stop loss goes just below the swing low of that pullback, and the take profit is set at 2 times the risk, 1 to 2 risk to reward ratio. Let's walk through a first live buy example. Here we can see the white line has been sitting clearly above 50 for a while, so the uptrend is obvious. Price pushes up, then starts pulling back. On the oscillator, the blue line drops below 20, while the orange line stays above it. That tells us the pullback is in progress. A few candles later, the blue line curls back up and crosses above the orange line. At that exact moment, we check the white line again. It's still nicely above 50, so the trend filter is still bullish. All conditions are met. We open a buy at the next candle open. You can set the stop loss below the last swing low, which formed during the pullback. Take profit is placed at exactly twice that distance. In this kind of clean example, price slowly climbs back with the trend, hits our 1 to 2 target, and we're done. Tip for this type of setup: don't chase it if the cross happens far away from the 20 level. You want the cross to happen soon after the oversold condition, not 10 candles later. Now let's look at the rules and conditions for entering a sell trade. Here we have a good example. First of all, we want the white Stoch RSI line must be below 50. That tells us the market is in a downtrend, and we only look for sell trades. Second, we wait for the blue stochastic line to go above 80. That means price is overbought inside a downtrend, so we're seeing a pullback against the main direction. Third, we wait for the blue line to cross down below the orange line while it's still close to that overbought zone. When that cross happens and the white line is still below 50, our sell signal is valid. We open a sell position at the open of the next candle. For the stop loss for a sell trade, just set it above the last swing high of the pullback, and take profit is set at 2 times the risk. Tip for this setup: avoid entering if the cross happens after a massive crash candle. Let the move cool down and wait for a proper pullback again. It's just as important to know when not to enter. We need to stay out when the blue line gives a cross, but the white line has already flipped to the opposite side of 50 by the time the cross happens. For example, blue goes below 20 in an uptrend, but when it crosses back up, the white line is now under 50. So in this case, we reject that buy trade. Or similarly, in a downtrend, blue line goes above 80, but when it crosses down, the white line has already gone above 50. So we reject that sell trade. These rejected signals are exactly how this strategy filters a lot of bad trades. It forces you to only trade oversold conditions in an uptrend and overbought conditions in a downtrend. Even with all these filters, you will still have losing trades. That's normal. No strategy has a 100% win rate. The goal is to have clear rules, a positive risk to reward, and to manage your risk properly so one bad trade doesn't hurt your account. This is going to be it for this video. Make sure to hit the like button and subscribe to my channel. Thanks for watching the video till the end. I'll see you guys in the next video.